Hello and welcome back to another episode of the Mills Knows Bills podcast. I'm your host as well as current CEO of MKB, Mills Bender. And with me today is Paul Childers for part 2 of our conversation, where he's going to be able to ask me some questions that he would like to know, whether it's on behalf of himself, his clients, his colleagues, doesn't matter. So Paul, thanks for coming back. Go ahead, and for those of the listeners that are just now tuning in, they didn't catch last week's episode, give a quick overview about what you do, please.
Yeah. First off, if you missed last week's episode, definitely go grab that, listen to it. It's good. There's free information in that will help you. I'm Paul Childers, owner of BlueSky Biz Solutions. We do business credit repair management, as well as help business owners go and find the right type of loan for themselves that's going to actually benefit them. So that's what we do. I'm really excited to start asking you questions because a lot of this stuff circulates around financials.
Okay, go for it.
My first question to you is, what in your time doing this, what have you found is the main reason that business owners wait so long to reach out to someone like you to help get their financials fixed and updated?
There's a lot of reasons. One of the bigger ones is that their profit and loss is lying to them and they don't realize that it's lying to them. So a few key components, there will be businesses that say that they run $10 million companies, but their gross margin is really $2 million, which means they're not running a $10 million company, they're running a $2 million company. But that's a conversation for another day. So with that, they feel like they're doing well financially because they're looking at that top line revenue. And they're saying, well, I'm bringing in all this money. I'm doing it by myself. Why would I need a CFO? Another issue that they wait so long, though, is because their revenue is so high, they don't realize that their cash flow is not doing so well. You can have great revenue and crap cash flow. And you can have not so great revenue and slightly better cash flow. Now, you do need good revenue to have good, consistent cash flow. However, just because you have that good revenue doesn't mean that you're managing that money coming in well. And so a lot of business owners will just look at their profit and loss, or they will look at what's in their bank account, and they won't see that something is wrong, even if it's not impacting them right away, because they're looking at the here and now. They're not projecting it forward. And then lastly, the profit and loss is lying to you. It does not include two key components that most businesses have: owner's draw and payments to your principal debt. So if your profit shows as $100,000, but you've taken $75,000 in distribution and $25,000 towards your debt, now your profit is really zero, but you don't realize that it's zero because your P&L doesn't show it as zero. So it takes them a long time because, like you in their business, they don't understand what questions they should be asking of themselves, and they only see certain pieces of the puzzle rather than what the entire financial picture is supposed to look like.
Well, and to kind of piggyback that off that, just myself kind of coming out of this mode. A lot of times, and you probably see this a lot too, when a business owner is going into survival mode, right? And you're just trying to do whatever you can to just make all your ends meet month to month. It's really easy to get into almost a lifestyle creep as well when you start coming back up out of that, where you start getting into, you're out of survival mode, now you're into growth mode, but you're still taking owner's draws and you're doing it more because you feel like you owe yourself a little bit more money, or you owe your family a little bit more money because you took all this time. And all of a sudden, I will self humiliate myself in this instance. But like, I looked at like a couple months ago, I was like, why do I feel like we went backwards this month? And I was like, what in the world happened? Like, I've made a ton of money this month. I don't understand why I feel broke. And I went and looked at our personal expenses, and our personal expenses were like $19,000. I was like, gah! I'm like, oh my gosh. I'm like, what have we done? But you don't realize it unless you track it. So
exactly.
So don't be ashamed of that either. I really want to be critical like that. So back to that though, when you identify that set of issues for a business owner? Like what are the next steps that you walk them through that you find to be the most meaningful to really help connect dots? Because I think for a lot of us as business owners, like we're squirrels, and so we get distracted easily
Yeah.
unless we really get things that connect things hard for us. It's
Yeah.
like it took that month of like super high expenses for me to be like, okay, lock in, right? Like, what do you see is usually that connector point?
Normally, the connector point is just having a conversation with them and explaining that if they don't have a CFO in their business, then they are the CFO, and asking them, are you qualified for that role? And if it's not a resounding yes, then it's a deafening no, And so it's basically being able to connect the dots of saying you don't have to wear all hats in your business. And sadly, your bookkeeper or accountant typically are not going to be that proactive financial solution for you. That's nothing wrong against them. That's just not their role. What's wrong is your expectations of them in that role. And so it's rewiring that thought process in order to show them, there is a solution out there. You just need to be willing to adapt yourself to that solution, which is hiring a full-time or fractional CFO.
And you made a really good comment, and we kind of talked about this before recording this too, but what are some of the key differences? So when you start talking to businesses, and I run into this too, and I go, you need to get a bookkeeper, you need to go get a CFO, you need to probably look into a different CPA. And they're like, well, my CPA just does all of it for me. Like,
Mm.
why is it so important in a lot of cases to almost have those three things, either two of them done with one company or all three of them separate, or like, what do you find to be the most successful way to do the bookkeeping, the CPA side of things, and the CFO stuff?
Well, the benefit of having it separated between 2 to 3 people is the checks and balances. And so, what I would suggest is have your bookkeeping done in house if it warrants it, or have it done with your CFO. Because typically, your CFO is going to take such a detailed route that it's going to end up making your accountant's job easier. And then your accountant and CFO can get together on what changes need to be made in terms of tax purposes. But the goal is to eliminate yourself from the equation as much as possible, not because you don't want to be involved or you shouldn't be aware, but because you should only be aware when it becomes a higher issue situation. You should be focused on things that your CFO and accountant can't do for you, which is bringing in money, hiring new people, training them, keeping your business running, right? So, it's important for you to have those separations because of the checks and balances, but also because you want to make sure that you have the best person doing the best job on your behalf.
And off of that as well, like, what are some of the key differences
Hmm.
between a CPA and a CFO? Because a lot of people, honestly, like a lot of people are like, well, my CPA does my books and they do my taxes and they do all this stuff for me. I'm like, I don't think you have it dialed in quite right on what they should be doing for you.
So hear me when I say that there is a unicorn out there that exists who can do all three of those components,
Hmm.
but it's a unicorn. Okay. It is not, it's not common. So let's kind of go through the three main steps. A bookkeeper is going to categorize your transactions in your business, money coming in, money going out. If they're a good bookkeeper, there's going to be incredibly detailed chart of accounts, meaning you're not just going to see revenue, you're going to see the three different verticals of how you make your money in your business. You're not just going to see utilities on your profit and loss, you're going to see internet, phone, whatever it may be, right? You want to have a very detailed book. You also want to make sure that your bookkeeper, though, is updating timely. I can't tell you how many times I get a set of books and they haven't been updated in 3 months, but that business owner is paying that bookkeeper monthly. That's a conversation for another day. But bookkeeper is categorizing those transactions reactively after they've already happened. A CPA or accountant is going to take those books and they're going to file your taxes, identifying any potential loopholes in the tax code to lower your tax liability as much as possible. But again, it's on a reactive basis. Okay. Bookkeeper, reactive categorization. Accountant, reactive and filing taxes. Where the business owner struggles is the now and the future, which is making proactive financial decisions, neither of which is those two roles we just mentioned. And that's what a CFO is supposed to do. They're going to take the information from the bookkeeper and they're going to forecast it, looking at industry trends, economy trends, seeing where you need to tighten up or where you get to double down in your business. They're the type of person you go to when you want to know if you should hire somebody or not. If you go to your accountant and say, when can I make a new hire? 9.8 times out of 10, your accountant is not going to know the answer to that. They're not. And that's not against them. That's against your expectation of them. And so you want to have an accountant who's great at tax strategy. You want to have a bookkeeper who's great at having detailed and timely categorizations of your books. You want a CFO who can take all that data and be that one point of contact amongst all of the financial professionals in your business and help you drive your business forward to achieve all those other goals.
Yeah, that's important. I see that a lot. I'm working with my CPA, I'm working with my bookkeeper. When's the last time you reviewed your books? I don't know, like 6 months ago. And I'm just like, oh, cool. That's not helpful at all.
Yeah.
We could be
Yeah.
majorly wrong. So, from like a CFO standpoint, when you start working with a business, like where do you see your guys' effect coming in, like the most influential in their business? Is it like just getting a better picture of it, or is it really in helping them get to a point where they're doing what really matters, which is taking more money home?
You know, the nerdy side of me wants to say that we help a business by making sure that there's money in the bank and they get to scale and grow. But if you ask our clients what we do, it's really simple. We give them peace. That's it. They trust the data that we're giving them. They trust the story that that data is providing. So that way it doesn't occupy as much mental capacity as it was beforehand. Just that like mental and emotional toll alone allows them to focus that energy on scaling their business more. And so in terms of the practical side of how we do that, we come in and we do an audit of their books. We see if there's anything that's miscategorized. We see if there's any room for improvement of having more detailed books so that way the business owner can open up their profit and loss and pull the story from the numbers themselves quicker. But most of the time, what we also see and how we help our clients is that their cash flow ain't too pretty. And so we get to the root cause of why it doesn't look so great. Most of the time, it's because their accounts receivable is way overdue. They just haven't collected. And now they need to leverage a loan in order to bridge their own financial gap, which is that interest that they're paying is eating into their own profit margin
Yep.
on that receivable
Yep.
that they haven't collected on. It's a vicious cycle. And
Yeah.
so what we do is we come in and say, is there a system or process that we can implement to allow you to collect your receivables in a more timely manner? What is the cost of that system or process? When can we financially afford it? Secondarily, what we see is that a lot of our clients don't price themselves well.
Mm-hmm.
So you need to ensure that you are adding in decent profit margins and not just what you think your profit margin should be, but what it actually is, inclusive of averaging out your overhead expenses, all those tiny little things that you tend to forget because you think it's just a normal cost of business. Yeah, it's a normal cost of business that should go against that proposal you just sent out.
Yep.
So we'll come in and we'll do a deep dive of trying to find the 2 to 3 root causes that are affecting their finances. And what we find is once those are fixed, then we just get to double down on things that they're doing well. It's kind of like slowing down to speed up.
Yeah. But that's such an important part of getting somebody out of that fight or flight mode
Yeah.
and into you can't scale. Well, you can't scale chaos, number one, but you can't scale when you
Shouldn't.
don't have a calm mind,
Yeah.
right? Like when you are constantly focused at just chasing the dollar because you don't have them coming in consistently, you don't have a way to replicate it and almost like predictable go, yep, okay, we're going to get this every single week.
Hmm.
You're always chasing. And if you're chasing, you're never growing. And
Exactly.
so a CFO will help you get out of chase your tail mode and into actual like growth mode. And that's why I tell people so often, like, it's so worth the investment. It's not an expense. You're going to go through a little bit of pain period. Stop avoiding putting the work in now for stuff that you're not going to see right away, but you're going to see it 6 months from now. And in 6 months, you're really going to be glad that you started to pay for it and started doing it today because it's going to open up an entirely different world to you.
Pay now or pay later,
Right.
in
Either way,
terms
we got
of
to
the
pay.
team bit, So,
Right.
well, as we wrap up on this episode, is there anything else I can answer for you today?
Yeah. I think the last one is, you know, as business owners scale their business, right? How do they know if they're picking the right CFO for them?
It's a great question. You need to first find somebody you can trust. If you don't trust them, even if they have all the accolades in the world, it's not going to be a good fit. It's like hiring a COO. You need to find somebody who's a good cultural fit, you know? And so, of course, look at somebody's accolades, but what I'm going to say has nothing to do with finance. Go with your gut. Your gut is what got you this far in your business. Go with your gut when it comes to choosing a CFO. And at the end of the day, you want a CFO who's willing to not have you hire them if it's not the right fit for you too. So have an open conversation with them. Ask them what you would have to do to make that CFO fire you as a client. And that will reveal a lot about them having your best interest at heart.
That's really good. Actually, that's a really good answer. And your gut probably is right the majority of the time. We just overthink things.
Oh, 1,000%. 1,000%. I can't tell you how many times I've had a client say, "Yeah, my personal expenses are $10,000." And sure enough, we calculate them and they're like 10,133. It's pretty close. It's pretty close. So don't discredit your gut. But with that said, thank you, Paul, for coming on for a part two. It was lovely getting to finalize this conversation with you, and I hope you have a great rest of your day. And thank you, listeners/watchers. I hope you all got some value out of our conversation, and we'll see you next week.